On Tuesday, the 18th of August, 2026, the U.S. Securities and Exchange Commission unveiled a proposal called Regulation Crypto Assets. The digital asset industry immediately hailed it as a major step forward. But the first signal is not what was proposed, it is how it was approved. The SEC bypassed its own public meeting schedule and used a seriatim vote, a written round robin, to release the draft. That is rare for a rule this consequential. The headline number is $5 million. If finalized, crypto companies could use a one-time exemption to issue up to $5 million in tokens over a 4-year period without full securities registration. To understand why this is happening now, look at the SEC's recent history. For years the agency relied on enforcement actions, which left crypto firms guessing whether a token was a security. Regulation Crypto Assets is an attempt to create a tailored securities offering regime for certain investment contracts involving crypto assets, rather than forcing them into rules written for shares and bonds. Crucially, this comes alongside Treasury proposals on stablecoins under the Genius Act, so it is part of a broader U.S. regulatory push. But not everyone is celebrating. Some commentators argue the SEC is effectively writing its own crypto law, because Congress has not yet delivered a clear framework. That political friction is going to matter. For a small crypto startup, the difference between full registration and a $5 million exemption is not abstract. It could mean a faster route to market and a defined path to raise seed capital by issuing tokens. That is why industry groups have called the proposal a win for the digital asset industry. But there is a trade-off. A lighter regime means fewer of the traditional investor protections that come with a fully registered securities offering. And because the exemption is one-time, it is a launchpad, not a permanent license. For investors, the trade-off is access versus protection. Do not mistake this proposal for law. It must still go through a public comment period and a final SEC vote, and legal challenges are possible because the agency is acting alone. The next few weeks matter enormously. Crypto firms will dissect the draft to see how key terms are defined, what ongoing disclosure is required, and whether secondary trading is restricted. If the final rule is too narrow, the $5 million headline could become a symbolic win. If it is workable, it could pull token issuance back to the United States and force other regulators to respond. That is the real tension. Competitive advantage versus an overreach courts could strike down. So what should you take away today, on Thursday the 20th of August, 2026? The SEC has shifted from enforcement by ambiguity to a concrete, numbers-based proposal, and that is genuinely significant. The $5 million exemption is the number to watch. But a proposed rule is only a proposal. The real story will be fought over definitions, disclosure, and politics. For founders, this could lower the cost of launching a token. For investors, it could open early opportunities while removing some safety nets. Treat this as a signal, not a guarantee. The next few weeks will determine whether Regulation Crypto Assets becomes a real market turning point or just a well-timed headline. Subscribe for more analysis.